First of all, thank you. Thank you for the invitation to be here with all of you. It's a pleasure to be here. So first of all, just like we say in Texas, and I just moved from College Station here to San Antonio, you know the famous word, howdy. I hope everybody's doing well today, and thank you for coming. So when thinking right now of what's currently happening with our economy, I think right now we're at an inflection point and a turning point. After the pandemic, the Texas economy, the San Antonio economy grew at a very, very high rate. So think about, imagine we were shot out of a cannon after the pandemic, right? After we shut down the economy, the Texas economy, San Antonio, boom, we were running, we went from 0 to 60 to 120, right? When our average speed maybe could be 65. So we were like this, right? And it continued in 2022 for the first 7 months of the year, up to July. And then in August, we saw kind of a peak, a slowdown. And if you look at the numbers, for Texas and San Antonio, Texas did not grow. Employment did not grow in August. Of course, it's just 1 month, but still you can see that slowdown after growing such a strong rate. San Antonio actually registered negative growth in employment in August. So to give you an idea, and there are other indicators out there, and I'll show you the evidence, the numbers, that we're slowing down. Now, the major issue facing us, right, San Antonio, Texas, the U.S., and the world, is not only a local nation issue, it's the world issue, it's inflation, right? So that's why the title of the phrase, amid high inflation, we are slowing down. And just to give you an overview of what's happening, let me just start with that. Let me put everything on. I don't like going little jumps. I mentioned earlier, the San Antonio economy slowed down in August. Employment declined, and unemployment did not change. The good news is that unemployment did not change. Like I mentioned earlier, the growth rate we achieved here in the San Antonio economy has been really, really strong, above historical numbers. So think about it, up to August, year to date, from December to August, employment is up here in the San Antonio MSA 5.0%. Really good number for the San Antonio economy. But even think about it, that's really impressive because even with the decline in August of minus 1.4%, we're still up 5.0%. In August. So that's really good news. The other thing, unemployment rate is 3.7, same as the U.S., lower than the Texas number, and did not change. But as I mentioned earlier, there are signs we are slowing down. The first sign comes from our surveys. Dallas Fed has a really, really good surveys, and two of those are a manufacturing survey and our services survey, where we go out and directly ask Texas companies in San Antonio and Houston and Dallas and El Paso, around the state in Austin, what's happening. And what the feedback we're getting from our Texas companies is that they are slowing down. So that's an indicator of that slowdown. Also, of course, a sector that's really, really highly interest rate sensitive is the housing market. And what we're seeing currently, as all will know, I think today, actually, mortgage rate, the fixed mortgage rate for a 30-year loan, home loan, reached 7% today. So think about a year ago, we were at 3.5. So now we're at 7. It's almost doubled. So that, of course, a sector that's really interest rate sensitive, the housing market, as we all know, we're seeing the news. If you're if you're out there trying to buy a house, you're seeing, it's an easier market, right? And you're seeing the slowdown in the housing market. And of course, construction also, you can see that, new home construction is slowing down. Another great indicator we have at the Dallas Fed is our Texas leading indicator. And that's a great indicator to know what's happening with economic activity in the state of Texas. And we're seeing the slowdown in that index for the past 4 or 5 months. It's showing a slowdown or signaling a slowdown in activity going down the road in Texas. So we have all these indicators, numbers telling us we are slowing down. Now, the good news for the remainder of the year, we're still going to achieve really strong growth in the Texas economy and solid growth in the San Antonio economy. So good news. So the momentum is going to keep on, and is going to make us end still at a solid rate of employment growth for San Antonio. Now, the risks. The risk, of course, another negative shock that hit the world economy, and we saw the effects of that during the summer. Just look at what happened to gasoline prices during the summer, right? The Russia-Ukraine war is still there, and the global economy is slowing down. Also, again, the persistence of the supply chain issues is still there. The disruption from the supply chain issues are still there. They're getting better, but there's still some of those negative factors are still there from the supply chain constraints. Now, major risk going forward is what happens if inflation does not start to go down as the Fed expects. That's going to force the Fed to tighten monetary policy even further. By that I mean raising rates more. And that can affect the economic activity going down the road, right? And even further slow down in the U.S. and Texas and local economy. Now, how did Texas and Antonio fare during the pandemic? I love to show this graph. It's interesting. The good news, each time a new state comes up to the list, we were one of the first states in the country to recover all the jobs lost to the pandemic. So since October 2021, last fall, actually a year ago, we recovered all the jobs lost to the pandemic, right? And each time I do this talk and update the slide, a new state comes into play. Now, U.S., just to give you an idea, U.S. our country barely recovered the jobs lost to the pandemic in July of this year. So think about the lead we had, the Texas economy leading the rest of the country to regard our growth, employment growth, recovering the jobs lost due to the pandemic. Just to let you know, just to give it in a different way, we're actually in expansion mode. Now, the issue down the line, as the economy slows down, think about it. Only 19 states of the Republic have recovered all the jobs lost to the pandemic. So what's going to happen to the rest of the states who haven't recovered the jobs lost to the pandemic when we starting to slow down? So that's a different scenario. That's a question we have to look down the road, especially for policy. So that's an interesting question, no? But as you know, Texas strong, the growth rate, and we've recovered the jobs faster than the rest of the country. Now, just to show you what happened to the MSAs, so this graph shows you which comparing the job numbers before the pandemic, the growth rate, to August, the latest number in employment numbers. So basically, what it's telling you, like I mentioned earlier, Texas has recovered the job loss to the pandemic, U.S., and also the major 4 MSAs in our state have come back to pre-COVID levels. And the majority of the MSAs in Texas also. Now, if you look at the numbers, the growth rates, they're different. They're different, right? Why does Austin is above pre-COVID levels, almost 10% jobs, right? Dallas is above 7.3%, right? So why is Austin doing so well? Again, this goes back to the industry mix. What are the major industries in Austin? Everybody? Technology. An industry that fared really well during the pandemic. It could socially distance, right? It wasn't affected by the pandemic. On the contrary, right? Expanded, it grew. Now think about Dallas-Fort Worth. Why did it do it also really, really well? Dallas, the majority of the jobs are in the professional business services and financial activities. 2 industries that did really well during the pandemic. They could socially distance and they recovered the jobs faster than other sectors in our economy. So that's why you see those differences. Of course, Fort Worth, major manufacturing hub in our state. Also warehousing, another sector that did really, really well during the pandemic. So again, San Antonio is there. It's up, but of course, San Antonio, major service industry, tourism, an industry that could not socially distance. That's why we're kind of lagging behind. Right? But the good news right now, people are still going out, traveling. All these things is a positive for San Antonio economy. Now, of course, Houston. Why is Houston the lowest? I know. Right now, the energy industry is totally different than it was during the pandemic, right? But at that moment, the energy industry was hit really hard. Think about the oil prices during that time. It was incredibly low, right? But right now, of course, they're doing well. So that's why Houston is barely coming back, but doing really well right now. Now, the recent economic performance, I'd like to show this graph. These are the comparisons. So we're comparing here employment growth between the U.S., is in black, Texas is in blue, and the purple is San Antonio MSA. So right away you can distinguish it. Texas, San Antonio, that blue line, the blue bar, and that purple line are higher than the black line. So Texas and San Antonio job growth has been above the U.S. San Antonio has been a little bit below Texas job growth, but still strong job growth and above trend, like I mentioned earlier. Now, this is the employment up to the month of August by sector. Just to let you know what's in the parentheses, these are the industries, right? By industry. What is in parentheses is the percentage of the jobs in that sector, the market share. So what am I saying by that? Trade and transportation utilities represent 18.2% of the jobs here in the San Antonio MSA. There's a major source of employment in San Antonio. So look what's happening. On the purple, we have the July to August numbers, right? The month annualized numbers, the monthly numbers, and the blue line has from December to August, the year to date. So first of all, what you're seeing, right, the monthly numbers, you see an overall decline in jobs in San Antonio in the month of August. But the good news, from December to August, all of them are positive and are registering a really strong number, right, of job expansion. So that's the good news. But there is the slowdown, right? Unemployment rates, you see unemployment rates for Texas and in the major MSAs in the U.S. Like I mentioned earlier, U.S. and San Antonio have the similar unemployment rate at around 3.7, below the Texas number. And what can you get from this graph? Of course, we have the pandemic, boom, we shut down the economy. Unemployment hits historical levels. And then what do we see? The decline as we opened up the economy. And of course, what are we seeing at the end? If you kind of look at the last part of the graph, it's plateauing. It's slowing down the unemployment rate. Okay? But still low. Wage growth, also, you're starting to see the slowdown in the wage growth numbers. During the pandemic, really strong wage growth number. And at the end of the graph, also, you're starting to see kind of the plateauing of the numbers. Of course, look at that green line for Houston, that big jump in salaries, right? And why is that? Because the energy industry, the Russia-Ukraine war, oil prices pushed up activity in the energy industry and benefited the Houston labor market, right? So that's why you see that big increase. And if you look at the salaries, comparing average hourly earnings by MSA, you're going to see that San Antonio is the lowest. And why is that? Think about the industry mix again. Services jobs don't pay as much as high-tech jobs or professional business service jobs or financial activity jobs. That's why you see the wages a bit lower than the other major MSAs. Now, I mentioned this earlier, what's happening with the energy industry. You can see now as oil prices are still high, the rig count is coming back up. Now, here we have another survey. We do a survey that we ask directly energy companies what's happening, what they expect to do going forward, expectations. In the past, Texas oil, right? We were talking about the 70s, in the 80s, the 90s, or, up to 2014 after the oil bust hit the economy, the energy industry. When oil prices rose at a very high rate, rig count activity in the industry would follow suit, right? But what's the difference between now and 10, 30, 20, 30 years ago? Well, we go out and directly ask them what's the reason why you're not increasing output given such high oil prices. Now, everything's related, right? Let me just start. Public companies, the first thing they tell us is because of capital discipline. Their shareholders. They're not allowing them to increase production. I'm talking about public companies like Exxon, right? Also, of course, the ESG movement, right? Where a lot of financing, a lot of companies, their money, they're not going to invest in companies that are carbon and not green energy. And that's affecting that also, right? And of course, the policies, federal government policies affect and they create uncertainty in that industry, and that affects output. Currently, those rig counts, the majority, the production that we're seeing in oil is coming from private companies and small and medium, large private companies and small and medium private oil companies. How's the housing market? I think this is important. So as mentioned earlier, it's slowing down. But if I showed you this graph, if I showed this graph for Texas, for Dallas, for El Paso, for Bronzeville, basically the same graph, what are we seeing? If you look at the numbers for single-family new home construction, we can see the decline in the construction of new homes, single-family homes in San Antonio, the same in Dallas-Fort Worth, when mortgage rates, of course, increased, right? You expect a slowdown in the industry. But look what's happened in multifamily. Still strong, strong, strong. Why? Because we know a lot of people are migrating, companies are migrating to San Antonio, to Texas. People still need a place to live. Right now, with mortgages so high, home prices still high, unfortunately, a lot of people cannot purchase a new home, right? Because of the cost right now, right? But still, people have to find a place to live, and you see that strong increase in multifamily. The demand for housing is still there. Now, I love to show this graph. This graph is basically inflation for home builders. Is the producer price index for home builders. By that I mean, these are the costs that home builders face when they try to build a single-family home and a multifamily home. So in this index, there's lumber prices, steel, everything a home builder needs as an input to build a new home. So the first thing you're going to see, right, you're going to be, wow. Of course, after the pandemic, when lumber prices increased above 100%, right? Major input for the home builders. You can see the big spike. They almost reached 20% year-over-year price growth. Think about that, home builders they're facing. Now, the good news, it's eased, right? The home prices the price pressures have eased. They're slowing down the growth rate of those prices, but still remain above 10%, 12%. That's another sign that our supply issues remain. And imagine you're a home builder right now, not talking about after the pandemic, think about it right now, and you're still facing increases in your inputs above 10%. Think about us. Think about the things we buy. Let's say we're going to go every time we go HEB, the basket of goods and services that we buy in HEB went up by 10%. I can assure you that you would be like, you know what, we're going to have to leave that steak tonight, right? Or we're going to have to leave the Fruit Loops or something, right? Every time less. So these are the home builders, right? So this is a major input. These are the costs for them. So another reason why we've seen such strong increases in home prices. Now, these are the home sales. As we know, home sales, and we've heard the news, everybody's talking about this, home sales have started to decline or slow down. And the major reason, again, the increase in mortgage rates is affecting home sales. Now, look at the last part of the graph. You can see they reached the peak, kind of a peak plateau. Now, let me just add one thing. That peak we reached that you see there, right there, that's before interest rates started to increase. But that peak kind of could have been even better. But the issue was the major headwind facing the housing market, even before the pandemic hit the economy, was the lack of inventory, the lack of homes available for sale. And that's one reason we saw such high increases in prices. So, again, plateaued, increase, strong home sales in every major MSA in Texas, and there we've seen a decline in home sales, right, due to the high mortgage rates. Now, another thing you can get to the graph, I like to show this graph, especially here in San Antonio, it's indexed to the same value, it's the same starting point. And also you can get from this graph is the growth rates. So think about, just look at the graphs, the lines through time, and you can see that the San Antonio line is one of the highest, meaning that home sales in San Antonio, the growth rate of home sales in San Antonio are one of the highest in the state, right? Higher than the other major MSAs. So even higher than the orange Austin. So think about it. So housing sales in San Antonio are growing at a higher rate than they are even in the Austin market. Not numbers, right? I'm not saying numbers. Of course, Austin is a bigger economy, has more houses. But in growth rates, the Austin market is growing at a higher rate. And that's been true since 2016, showing you the strength of our housing market. Just an extra comment. In March, we have a joint conference with the Texas Real Estate Research Center and the Dallas Fed on real estate markets here in the state of Texas. And we had the chief economist for Metro Study, Sonda. They focus on new home construction. And she was asked directly, point blank, what what MSA or what region or what city do you think right now is the best city to buy a house and to live in that city? Given price, opportunity, growth, all these things, right? And what city do you think she answered? San Antonio, of course. She said San Antonio. So long run expectations for our state, for San Antonio, are positive. I know right now, short run, we're slowing down, but long run, still a strong expectation, positive outlook for the San Antonio economy and, of course, the housing market. Now, this is the major issue that we've been facing even before the pandemic. After the pandemic hit, there was a big increase in the demand for housing. And that increase in the demand for housing was based on, first, the historical low mortgage rates that were prevalent at that time. Also, don't forget the preferences. People were not commuting to their office. The hybrid working model. A lot of people wanted a bigger house, right? The checks we got in the mail, right? A lot of people used that money as down payment to purchase a home. I think that played a role. The millennials coming of age, right? Also trying to buy a house. So think about all these factors, and that pushed the demand stronger. But when demand increased, the issue, the supply of homes, the availability of homes available for sale. And that's been an issue. A normal market is expected to have 6 months of inventory. And as you can see, all the markets in our state basically are below that. And look what happened after the pandemic when we reopened the economy, when everybody went out and tried to buy a house, basically. And inventories fell even further, almost reaching below 1 month in case of Austin, or close to 1 month even in San Antonio. But what we're seeing now, that the housing market is slowing down, we're seeing an increase in inventories, months of inventory, but still low numbers. And that's another reason we saw such strong home prices. And this is the medium home price. As you can see right away, as demand has weakened, you can see at the end of the graph that medium home prices are declining. Now, why are they declining? This is medium home prices, the composition effect. In these numbers, you have homes with a price tag of $500,000, $350,000, $100,000. So that affects the median, right? It's like think about like an average, right? It's going to affect what's happening to that. What's happening right now, the houses with a higher price tag are not being sold as much, right? Or there's no demand for those homes with that price tag, especially with mortgage rates around 7%, right? So that's why you're seeing a decline. Now, another question that I get a lot is, what's going to happen are we in a bubble, or what's going to happen to home prices in San Antonio, since we recorded such high numbers in Austin and Dallas-Fort Worth? But think about it, the issue was not, think about the 2006, 2007 housing boom and bust. What were the three factors that caused that bust? First of all, was loose lending standards. Basically, what was the joke at that time? Anybody with a pulse would get a mortgage loan, right? That's not currently happening right now. If you look at the FICO scores, if you ask a mortgage banker, they're going to tell you, no, my clients are qualified to own their home. Totally different. And of course, the lax oversight that permitted those practices, right? Our institutions failed us. Our supervisory institutions failed us at that moment. That's not going to happen. And also the investment motive. A lot of people were flipping houses, right? They were buying 2 or 3 houses and flipping them. That's not currently happening, right? A lot of people do wanted the bigger house because I needed the office to work from my house. I needed that office there. And that caused an increase in demand. It was more because a structural issue, a lack of supply. So it's really rare in our history, especially in a community like San Antonio that's growing so much, to have falling home prices. But by that, what I mean is that you bought a house 3 years ago in San Antonio, right? And then you go to the market right now, or 5 years ago, and you try to sell a house. It's not going to sell below the price you paid for it, right? That's going to be really, really difficult, right? That's not going to happen, right? Normally, you're going to sell it at a higher price. That's what I feel with nominal prices going down, especially in a community economy that's strong and it's growing and has a positive outlook going down the road, right? For that to happen, the major source of jobs would have to disappear, right? A national disaster, something that says, you know what, I don't want to live there anymore, right? And people move. That would cause a collapse in housing prices. Now, I love to show this graph, And this graph is the relationship between, basically just to show you inflation through the history of the US back to the 70s, and the 30-year mortgage, that's in the blue line, and the 10-year treasury note. So since inflation was so low for so long in our country and wasn't an issue, as former Chairman Greenspan said, when you don't think about inflation, it's not a problem, right? And we didn't think about it for between the 90s and the 2000s. Nobody was thinking, oh my God, inflation is high, oh, prices. Nobody was saying that, right? That's called price stability. So what happened to interest rates? They were low. Think about your class, your one-on-one class in finance, right? A nominal interest rate equals the real rate, the rate of return the bank wants from you, plus what, everybody? Inflation. If inflation goes up, interest rates, nominal interest rates go up. It's easy as that. So what's happening now? Look at the last part of the graph. When inflation went up, that black line, what happened to the 10-year treasury and what happened to the 30-year fixed mortgage rate? It went up also. Of course, right now we have the Fed tightening monetary policy, but inflation, no. Look about the 70s. What happened during the 70s? We had very high levels of inflation, and we also had very high levels of what, everybody? Of interest rates. But also we had low levels of growth. So that's the importance of having price stability. It's a necessary but not a sufficient condition to achieve long-run sustainable growth that benefits everybody in the country. So think about the 90s and 2000s when we had very low inflation. The economy did really well. We grew at a very high rate for long periods of time and benefited a lot of people. So that's the importance of having price stability. This is not a theory, it's a reality. If we look to the history of the countries in the world who are done a great job, growth rate, benefit to their population, to the citizens, what would you find? One characteristic you would find is what, everybody? Price stability. So that's the importance of bringing back down inflation. Of course, in the case of the U.S., in this case, inflation expectations were not well anchored in the 70s up to the 80s until a Fed chairman came into power. That was Mr. Paul Volcker, and he mentioned, said this is enough. Inflation is a problem for our economy going down the forward, and we have to bring it down. And I think the Fed, if you look at the numbers, did a good job doing that. Now, the sense of slowing, just to show you this. This is based on our surveys. This is what we asked Texas companies, manufacturing companies, and service companies in the state of Texas, in San Antonio, Austin, Dallas. What are they seeing? So this is the question we're asking them here, the new orders. Are you getting new orders? Yes, no, or the same, right? And the other thing, that's the red line, new orders. And the orange line is the growth rate of those orders. So basically, are they increasing or are they decreasing, right? The growth rate of the orders. Now, if you put that together, if you graph it with Texas employment, right away, look, there's a relationship. You can see that the orange line and the red line lead the blue line. When that orange line and red line start to go down, then the blue line also starts to go down. It leads it. Think about the 2008 recession. You can see that orange line and red line going down first. And then what happened to employment, everybody? It went down after that. 2014, during the oil bust. That's why we see that decline right here. That's the oil bust right there. Of course, this economy is more diversified now, right? We have tech, we have manufacturing, financial, there's a lot more industries. The economy did slow down, but we did not enter a recession. Of course, the pandemic is another issue, right? It's a health problem. We shut down the economy. Of course, everything went down. But think about what's happening currently. What Texas companies are telling us. Their new orders are slowing down. Employment is still strong. So what are you going to expect now? For that blue line to what happened? What's going to happen to that blue line? Job growth. It started to go down. Exactly. Now, good news. This is also from Texas companies. We're asking them what's happening with your input prices, the growth of your input prices, what they use in their production and services also. What's happening with their selling prices, the prices they sell to their customers. We're asking them about their wages they pay to their employees, manufacturing and services. And look what happened. Look, when the run-up of inflation, you can see right here, the inflation pressures. Selling prices, input prices, wages were increasing, right? And of course, what happened, we can see right now, with the inflation every time we go to HEB. You're seeing that, right? But look, the good news, they kind of reached the peak. That's what Texas companies are telling us. The growth rate in manufacturing, wages, selling price, input prices, also for services, kind of reached the peak, and now they're starting to go down. And that's a great news going forward with the issue of inflation, right? That means, that would indicate, signaling that inflation pressures are going down the road, right? So that's the good news. These are job openings. Another characteristic of expansion we've been through after the pandemic is the strong labor market. So these are the job openings for Texas. JOLTS numbers are the official numbers for the Texas economy. How many people, the percent change from 2020? Historic job openings in the state of Texas, reflecting the strong labor market. But we have other two sources, weekly sources, Indeed, like the company we see those commercials. So they also produce numbers, stats about what's happening with the job openings they see in their company. And Lycast does the same thing. And look at the end. You can see right away the JOLTS numbers are already kind of plateaued, reached a peak. The same for the Indeed numbers. They're slowing down, the job openings, and also Lycast numbers. Was it last week or 2 weeks ago? We saw the job openings numbers, and you can see that they fell. No, last week, yes, the U.S. numbers at a strong pace. So the job market is kind of easing from its tightness. And so the outlook for the Texas economy is still positive, like I mentioned earlier. We're still forecasting 4.2% employment growth in 2022. A little bit lower than the 5.9 in 2020, but really strong number for the state of Texas. Just to summarize, Texas employment is expected to grow between 3.7 and 4.8 for 2022, more slowly than 2021, higher than nation, all still, right? But still above trend. San Antonio is expected to register still solid employment growth for 2022. But you saw it, we talked about it. There's signs of slowing down in the Texas economy and in the San Antonio economy included, right? And in the country also, and in the world. That's the thing that's happening all around the world. It's not just local, right? Again, we saw that the interest rate sensitive sectors like the housing market is slowing down, right? Construction, they'll be the most impacted. But again, leading sectors like manufacturing will expect to slow before services. And we saw that today in part of the inflation numbers today. We saw that the inflation for goods kind of was slowing down more, and for services actually went up. But the price pressures will likely remain elevated for the remainder of the year, unfortunately. And again, the goal of the Fed is bring back to inflation to its objective of 2%. Why 2%? Because that would would be the number to achieve long-run sustainable growth in the Texas economy. Now, the risk out there is that growth could slow further. Why? What happens if inflation does not go down as expected? Right? That would cause the Fed to tighten even more, right? And that would cause the economy to slow even more. So that's the risk out there. But again, like I mentioned earlier, we need to bring down inflation again, right? I think that's the major goal. Again, as I mentioned earlier, it's a necessary but not sufficient condition to achieve long-run sustainable growth for everybody. We need that, right, for the economy. So that's why the importance of bringing back down inflation. Thank you very much. Thank you for having us. It's a pleasure to be with all of you today.
Thank you, Luis. But the first question I wanted to ask, because we've gotten this from several people, what do small businesses need to know for, preparing? Because if it's slowing, what can I do as a business owner?
So I think you have to start, like they said, hopefully there's a good phrase that a former president, director of the International Monetary Fund said that you fix the roof, right, when it was sunny. I hope you're not fixing the roof now it's raining, right? That would be the issue, right? And I think you have to be looking out and be wary of the slowdown. and take that into consideration for your business decisions. Basically, that would be my recommendation, because as I showed you, we're slowing down. So, yeah.
Some people are having big events, coming up in 23. One of the things I know we have to look at is like buying things. Like, let's say I have a quinceañera or some other big celebration. I could either buy the things now, knowing what we know now about this is like a supply chain issue, knowing what I know about the prices now, or I could wait like 6 months. What would you say to do in general?
So there it gets tricky, right? We cannot give recommendations that way, right? I can tell you what to do. The Fed doesn't do, interest rate forecasting or recommendations. That's not our. But let me just say, I'm not going to tell what individuals or companies or firms or to do, right? But think about it. What's happening, and the expectations are that prices should go down, right? As the economy slows down, prices should go down, and also the supply chain issues should start to disappear even further, right? So I hope that gives you kind of right?
Okay.
I like your analogy of fixing the roof, and I think that what we're seeing right now in the banking industry is, if you're trying to fix it when it's raining, you're going to be in trouble. So right now, with the interest rate environment, as it is, for businesses, we're telling them to just try to avoid floating rate loans, variable rate loans, because that's really where it's going to make a big impact to your bottom line. So it's kind of weird, because that's what we're seeing right now. We're seeing a lot of nervousness from customers, but I think if the Fed ends up raising rates even more, then we're going to see a lot of panic, from our businesses, in general. The supply chain issues, we saw a lot of that, of course, and we're still seeing some. I've never seen any of my customers have to search the globe for inventory and buy inventory from Pakistan and from India that they've never had to do before, so now they're out there in the global environment that they had never had to deal with before, so that's a whole new issue. So anyway, I guess we could just talk about this all day long, but that's a great presentation. You wish everybody could see it, because that way they can understand the big picture. Even though in a macro sense, it's the same thing that's going on in our economy here in the Southside. But anyway, thank you so much. I appreciate it.